Hi, thanks for being here and thank you for watching. This is going to be a shorter video that is part of the first time homebuyer series. I made an initial video that was much longer that talked about the step-by-step process of purchasing your first house. And that video touched on a series of different points that I wanted to expand on shorter videos. I did not want to make that other video too long. I thought it would be best for me to add some smaller videos that complement it. And this one is about PMI. In this video, I am going to discuss what PMI is, the different types of PMI. Yes, there is more than one kind. The loans that do not require PMI, when it's appropriate to have PMI, how to get out of PMI, and then some additional resources that you might find helpful. But first, here's a little bit about me. Welcome to my channel. My household consists of myself, my husband, and my toddler. My mom also lives with us, but she's not included in our finances. We live in a high cost of living city in the Northeast. My husband and I both went to graduate school, but fortunately, we no longer have student loan debt. I work in banking and he works in aviation. I take care of the family's finances and I love my role as the self-appointed CFO. I love to talk about all things money, whether it's investing, saving, or making money. I look forward to sharing a wealth building journey with you. I look forward to getting to know you, and I hope you enjoyed this video. What is PMI? PMI is an acronym that stands for Private Mortgage Insurance. It is a type of insurance that a buyer pays for when they are buying a house with less than 20% down payment. PMI is intended to protect the lender, not the buyer. The idea is that somebody who purchases a house with less than 20% down is a higher risk borrower than someone who is purchasing with 20% down or more. As a result, you pay a premium on private mortgage insurance with the intent of protecting the lender's investment. The cost of PMI depends on a lot of factors. The cost can range from anywhere from 25 basis points, which is 0.25%, to up to 2% of the loan balance annually. And that price depends both on the borrower and the property. Someone with stellar credit might have better PMI terms than somebody whose credit is not that great. Because remember, the idea is to protect the lender from what they think is a riskier buyer. But it also depends on the property. Because you are paying as a percentage of the loan, if you have a really expensive property, your PMI is going to be a higher amount. What are the types of PMI? There is more than one way to get private mortgage insurance. The first one is what they call borrower paid PMI. That is the one that most people think about when they think of PMI. That's the one that most people are referring to, because that is an amount that is included in your monthly mortgage payment, and you pay that amount monthly until you reach the point where you don't have to pay it anymore. The next one is called single payment PMI. Single payment PMI is an amount that you typically pay upfront at closing. You do not have a monthly payment that goes towards your PMI. They calculate the amount and they roll it into your closing costs. Whether you're bringing cash to the table or you're rolling it into the loan, the idea is that you pay it all up front. The third one is what is called lender paid PMI. Personally, I think that's a misnomer because the lender doesn't really pay for it. At least they don't pay for it without getting it back from you. You are still the one paying, but they price it and they structure it a little bit differently. The lender fronts you the amount, but then they give you a higher interest rate than you would normally get if you had paid for it in a different way. That higher interest rate allows them to recoup back the funds within a certain period of time. And the final type of PMI is what they call a split premium PMI. It is a combination of a monthly payment and a lump sum payment, a hybrid of the borrower paid PMI and the single payment PMI, where you pay a portion of it upfront and then the rest is divided over the course of your monthly mortgage payment. Once you pay that money, you never get a penny of it back. This is one of the things that you need to remember when you do have to pay PMI. But not every loan requires PMI. If you are enjoying this video so far, don't forget to hit the like button so the algorithm knows that it's good, and of course subscribe for more content. If you think any of the information that I provide here might be helpful to somebody else, be sure to share it with them. There are two main types of loans that you can get in the United States that do not require PMI. The first type is a USDA loan. USDA loans tend to be income-based loan programs that are directed for borrowers that are buying in rural areas, or at least an area that is considered rural by the USDA standards. And the next type of loan for which you do not have to pay PMI is a VA loan. VA loans are administered and facilitated by the Department of Veterans Affairs. Those types of loans are not income-based and they do not tie you to any particular areas. However, you do still have some qualification requirement. One of the main qualifiers is that one of the borrowers has to be a qualifying veteran. But you still need to be careful. Both of those loans include what the government refers to as a funding fee. You could argue whether or not that is considered PMI by just another name. After all, the funding fee is also based on a percentage just like the PMI, but when it's all said and done, the funding fee for both of these loan types are capped at a lower amount than what your conventional PMI percentages would be. Not to mention, we can't forget the fact that the VA funding fee is actually waived for disabled veterans who have a disability percentage above a certain amount. It is in fact possible to buy a house with less than 20% down if you're a veteran with no type of fee, whether it is PMI or a funding fee, whatever they might call it. You are able to buy a house if you are a qualifying disabled veteran. But we have to ask ourselves, when is PMI appropriate? There is no question that putting 20% down on a house is ideal. It is ideal for a lot of reasons. For starters, you are demonstrating very strong financial health to be able to come up with 20% cash. You are also putting yourself in a position where you are less likely to end up upside down on a house, and you are of course lowering your mortgage payments. But despite the benefits of having 20% down, we cannot deny the fact that it is not possible for everybody. Right now, we are in an insane housing market and we have to be realistic. There is a bald guy with a goatee and some round glasses who harps on about putting 25% down on houses. And this guy could not be more out of touch with the reality of the average American. Personally, I think it is important to give people options. I think one of the reasons why people struggle with personal finances is in part, not exclusively, but in part because we make it sound so inflexible that it is discouraging. That is not my philosophy. I think it is very important for us to acknowledge that we need to adjust our expectations with the reality of the times. So with that said, I think there are times where PMI is more than appropriate, and I'm going to give you 4 of them. If your down payment savings are growing much slower than the price of housing, it is okay to consider PMI. We are in a crazy housing market. In the past 2 years, we have seen people negotiate $50,000, $75,000 to $100,000 over the asking price. And I'm really trying to figure out how long exactly would it take someone to save up for a house when house prices are jumping up $50,000, $75,000 or $100,000. For every $100,000 increases in house prices, you would have to save an extra $20,000 in order to keep up a down payment that is sufficient for 20%. What sense does that make? I don't think that's realistic for the average person, and I think that is a circumstance under which we can consider PMI, and it is not a bad financial decision. Number 2, when house price appreciation is going to allow for a very quick removal of PMI. It is a slight variation of the first one, but this is less about how much you can put down, but more about the value of the house. You're looking for 75, 78, or 80% loan to value in order to make sure PMI gets removed. If you live in a very hot housing market, you're not going to be paying PMI for long. PMI is an added expense that you don't need, even if you can afford it. I mean, who likes to give away free money? I know I don't. PMI is not money that you'll ever see again. gone, it's money that is gone forever. But if price appreciation allows you to remove it much faster, it makes sense that you would want to put yourself in a position where you might as well get in a house, pay PMI for a short period of time, and the value of housing increasing in your area is going to eliminate your PMI. Number 3, if you are buying in a high cost of living area, I get it. Some people live in areas where a 3-bedroom, 2-bathroom goes for $200,000 or $250,000. That's good for you. That's fantastic. But that is not the reality of a lot of Americans. In the summer of 2021, the median house price in Suffolk County, Massachusetts, which is where Boston is located, my hometown, the median house price was $800,000. In order for you to buy a house with 20% down, you would need approximately $160,000 in cash. Not your emergency fund, not your retirement fund, not your sinking fund for your new car, just plain old cash sitting in your bank account waiting as a down payment for a house. It is not impossible. I certainly paid 20% down when I was buying my first house. Granted, my first house was not $800,000. I want to be very clear about that. But I bought with 20% down and I paid closing costs. So I know it can be done, but that's not the reality for most people. And to tell people that they have to have 20% down and they have to have 25% down, that is not applicable for the entire country. And we have to meet people where they are. If you are buying in a low cost of living area and you have done the best that you can, and you feel like you are ready and you can afford those monthly mortgage payments and you have a 6-month emergency fund, it's okay to get PMI because you might have $100,000. You might even have $80,000, right? 10% down. I don't know that I would let that stop me today if I didn't have 20% down. I'm giving you permission. Go right ahead. Buy it. We have to be realistic about the housing market, about where people live, about what is possible for them. And number 4, which is, I think, another time when PMI is appropriate, it's when PMI is low enough to not impact housing costs. If you find yourself with stellar credit, not buying a very expensive house, and PMI is a measly $50, $75, $150 a month, I want to know why you would think that an extra $100 a month is a good enough reason for you to not fulfill your dream of being a homeowner. How much are you paying in rent now? There are plenty of people who buy and say they pay either the same amount that they were paying in rent, or perhaps they find that their mortgage costs are less than what they were paying when they were renting. I know owning is not for everybody. I know that owning has more costs than just the mortgage payments. I know I've been a homeowner since my 20s. I not only own the house that I live in, I also have 2 rental properties, but I'm not talking about whether or not people should buy. I'm talking exclusively to the people who want to buy. They have already made that decision. This is what they want for themselves. This is part of their goal. And I am asking, why allow $100, $150 a month in PMI? Why allow it to keep you from buying? You might be able to get rid of it in 18 months or in 24 months. If your housing market is relatively hot and housing prices are going to increase, you're going to be able to get out of that PMI. It's a very temporary situation. Don't let that keep you from buying. I talked a lot about getting out of PMI, but is it possible? How can you get out of PMI? Yes, it is possible to get out of PMI. In fact, it is your right as a homeowner, courtesy of the Homeowners Protection Act, also colloquially known as the PMI Removal Act. But how you get out of it is going to be a combination of other factors like the lender's policy or the loan term that you have. At 78% loan to value, when you have 22% equity or more, you may be subject to automatic removal of PMI. You also have the ability to have PMI removed if house prices have gone up in your area and you feel like your house has gained enough in value to put you at 20% equity. You are able to work with your lender and get a new appraisal at your own expense. Appraisals typically cost a couple $100. You pay for that, they reassess, and once they review the appraisal and you have 20% equity in the house, you can have PMI removed. Some loans require you to refinance. You have to refinance completely out of that loan in order to get out of PMI. If you have an FHA FHA loan, you cannot simply remove PMI. You have to refinance out of the FHA loan into a conventional loan in order to have it removed. And again, thanks to the Homeowners Protection Act, you can get out of PMI automatically halfway through the loan. We understand that not everybody lives in an urban area, not everybody lives on the coast. Some people live in areas where house prices don't rise as much. Also, we might find ourselves in a situation where there's some kind of recession or housing crisis and house prices fall. But if you're halfway through your loan, you can have your PMI removed. That is the law. And halfway through your loan means that if you have a 30-year mortgage, once you're 15 years into it, or if you have a 15-year mortgage, once you are 7.5 years into it, you are considered halfway through. Here are some references and some additional information that I am going to include in the description box below. Please feel free to refer to those if you need some more information, or you can leave me a question or comment below. The first one is the eligibility section for the USDA loan on the USDA website. The next one is the VA loan website. I am also going to throw in the website for FHA loans. And finally, I am going to link the full Homeowners Protection Act down below